Damn this bull market. Let's call it the bullshit market. Or is it really? I know the market has been testing us in all kinds of fun ways recently. It seems like we've missed selling the top. However, the second quarter of 2025 could be shaping up to be a launch pad for the next leg of this cycle. Will it be the last leg? Well, time will tell. But the next leg, more likely. Stay until the end to learn out how things could be moving forward. Maybe, just maybe, your Lambo dreams are going to come true by June. Now, I know some of you might have already given up. I can see the views. I can see the sentiment. I know. You're simply fed up with all the sideways or just downward pukey price action. But the market does not move in a straight line. It never does. Consolidations, dips, whatever the hell this has been, it's all pretty normal, actually. Moreover, zooming out and looking at the bigger picture and the macros could give us a clues on the possible outcomes. Either this is a growth scare or markets are really screwed. But if it is a growth scare, what are the narratives for that? Well, let's talk about the Fed. The Fed is still pulling the strings that greatly influence not just U.S. markets, but really global markets. In a nutshell, they literally have the keys to the money, okay? If they say, okay, that's it, the inflation number is good enough, we need to grease the wheels of the economy, then bada bing, bada boom. Interest rates go down. Next Fed meeting is in May, and a lot of people are going to start front-running the narrative that Fed cuts are coming in May, or at the very least June. Borrowing money thus becomes a little bit cheaper. Cheaper money flows for business expansions. People start buying more real estate. Risk assets like stocks get squeezed up. This is what we want to see. Lark. Papa Powell and the Fed overlords weren't in any particular hurry to slash interest rates at the last meeting, so why would they do it soon? Yeah, I know. I watched the speech too. However, there are some telltale signs that the Fed is going to give more breathing room soon. JP Morgan analysts say the Fed might completely end QT as early as Q2 2025. So maybe at the next Fed meeting, they'll announce that, or at least in June. Why? Well, bank reserves are hitting a sweet spot right now, around 10 to 11% of GDP. The reverse repo facilities, the $2.3 trillion liquidity buffer, is almost drained. So quick explainer, bank reserves are cash that banks keep on hand, kind of like the rainy day funds to cover, of course, withdrawals and to keep basically the whole financial system running relatively smoothly. The Federal Reserve likes to keep them at a relatively comfy level. Think of it as them needing to have enough gas in the gas tank to avoid stalling out. Then there is the reverse repo facility. Pretty fancy term, but it's basically a parking lot for extra cash that banks and money market funds don't really need right now. Now, that actually ballooned out to $2.3 trillion during COVID when the Fed flooded the system with gargantuan sums of money. Right now, the parking lot, though, pretty damn empty. Once it is gone, well, the Fed doesn't need to keep tightening anymore. They've already squeezed out the excess. Now, there has been some money coming into that from the Treasury's Treasury General account, which is kind of providing something of a shadow QE, if you will, but not really QE, and the Fed's not going to do QE unless there's a crisis. But JP Morgan is calling for the first half of 2025 for the QT to end. Right now, Q2, we're in the window, baby, and this report might be right on the money. The Fed's slowing down its cash cleanup. They've been letting $25 billion in Treasury bonds expire each month without replacing them, which sucks money out of the system. But now they're reducing that by 80%. They're doing just $5 billion a month right now. Here's the deal. Right now, they're tossing out up to $25 billion monthly. That's already reducing, though. In April, that gets reduced to $5 billion. That's a huge reduction and provides a lot of relief to financial markets. That leaves a lot more cash sloshing around for everyone. And guess what? That extra money could easily splash into exciting stuff, stocks and crypto. Speaking of money, get your wife, get your kids, get your grandma. We're going to talk about the M2 money supply, the metric that tracks every dollar in play. According to Forbes, since the start of 2025, the global M2 money supply covering 21 major central banks has seen a 3.8% increase, which, may not sound like that much. Really, 3.8%, what's that? That's trillions and trillions of dollars. That's acceleration. It climbed from 102 trillion to around 107 trillion, almost 108 trillion by the end of February. The good news is, historically speaking, this affects Bitcoin's price anywhere between about 70 and 100 days approximately. This is the reason why some macro analysts like Raoul Pal think that the waiting game could almost be over if we correlate with global M2 money supply, as we so often do. Fingers crossed. We could be seeing some fireworks soon if this historical correlation correlates once again. Now, real quick before we get into the next reasons, guys, if you're trading these cryptocurrency markets, I know a lot of you guys are, and you want a great place to go long on the rips, go short on the dips, trade all the big coins. We're talking about Bitcoin, Solana, Ethereum, top dog coins, whatever you might want to be trading. Go check out Femex. There's a link down below. You can actually get up to $30,000 in trading and deposit bonuses. So go check it out if you're an active trader. It's a great place to be doing some trades. Link down below. Now let's talk about the elephant in the room. Trump's 4D chess, aka tariff uncertainties. There's major buzz around Liberation Day, which is tomorrow. The S&P 500, the NASDAQ Composite, they posted on Monday their worst quarterly performances since 2022. Thanks, of course, to worries over the United States versus basically everyone in the world right now and the big trade war it's brewing. But think about it. Higher tariffs could mean pricier goods. Spooky. Consumers are freaking the F out right now. Markets reacting in unison to that fear, right? We're looking at potential hits to corporate earnings, especially for the big tech giants, the Magnificent Seven. They've already hit a technical bear market, but these guys are reliant on global supply chains and they need certain products. And if they have to pay too much or consumers don't want to buy it because the price, it's a problem. But here's the secret sauce. You see, this uncertainty might actually be setting us up for a major rebound. If April 2nd comes and investors realize that, well, maybe all this tariff fear stuff was pretty overblown and countries are going to start making deals to work with the United States instead of against the United States, because everyone's access to US markets at the end of the day, then we could see, at the very least, a relief rally, if not a trend reversal. And I know charts right now look cooked as fuck. I'm looking at the same charts, I understand. But that could be the growth scare part. Charts look bad, but fundamentally, things may not be as bad as people are currently counting in. Capital could come rushing back into risk assets in a very quick way, resulting in the S&P 500, the NASDAQ rallying. Plus, with Q1 earnings season kicking off in April, any tech or consumer company showing strength could flip the narrative. Of course, when the traditional market pumps, Bitcoin, the rest of crypto, your dog coins, they're usually not too far behind. And if you look at the market sentiment, well, we have been in the fear zone recently. In fact, extreme fear territory for quite some time now, both for the stock markets and for the cryptocurrency markets. And what's crazy is that for stock markets in particular, the level of fear from investors is the same level of fear that people had at the bottom of the 2022 COVID crash, and at the bottom of the 2008 crash, and at the bottom of 9/11. That's how bad the fear has been after just a relatively small move for stocks. The consumer sentiment has been crazy, crazy bad recently. Literally record bad, along with the worst bottoms of the worst dips and crashes we've seen in the markets. Does that feel irrational to you? All this could easily do a 180 turn once there's more clarity on how countries are actually going to end up reacting. Trump himself has expressed some level of flexibility on the matter. Part of this also about spooky markets, driving people into bonds to get the bond rates to come down, all that kind of stuff. Look, on a technical side, I found a nice post here from COINTRACKING over on X. He thinks in early April, regular stocks like the S&P 500 index might dip down below 5,500. But we've already seen that yesterday, actually. But Bitcoin will hold strong above 76K, which is what happened so far. Maybe there's going to be a further sell-off later this week, but largely the market could have already sold the rumor and they could be now buying the news. Still a lot of volatility to watch out for this week, obviously, but keep an eye on the market's fear meter, which should stay relatively low, meaning things won't get too wild too quick. People are still rattled and they won't just immediately aim everything back in. Now let's talk about vibes. Sentiment's been absolutely rough recently with all the tariff drama we mentioned, but this could see a setup for the bounce coming in. Instead of headwinds, as CoinTrader was saying, we could actually see tailwinds going into April, May, and June. Again, global M2 money supply, reversal in trend in stocks, and expectation of rate cuts and all that kind of stuff. So it's good, but don't go flipping through the Rolex catalogs just yet. We'll see how things play out. And now the last reason is all about the shiny stuff, the gold, baby. You see, gold's been making headlines. It's been making all-time highs like it's a hobby. In fact, it's reached more than $3,100 per ounce, a 10% move up from a month ago, which is gargantuan. That's trillions of dollars in extra market cap for gold. Here's the kicker, though. Bitcoin tends to follow gold. It's not a perfect correlation. We did a video on that, but often it tends to have a bit of a rhyming effect to where gold goes. According to Caprioli founder Charles Edward, Bitcoin tends to lag behind gold by a few months, much like it lags behind the global money supply. So if this thesis holds true, then we could be looking at a good pump by the end of Q2. Interesting. Maybe it takes still the second half of the year. We have done a bit of damage recently. Don't expect us to run back to new all-time highs, but we could start reversing the trend. And that all sounds pretty good, right? But before you go out and start choosing the color of your new Lamborghini, you might just want to hit the brakes a little bit and just consider here that we still have a lot of work to get out of the woods. There's still a lot of fear and charts are still looking mega cooked. But I think that we could be seeing at least one more glorious pump on these markets, potentially over the next few months with a sort of buy in April, sell in June, potentially kind of vibe if we're following along the M2 money supply. Now look, that doesn't mean we don't get another pump later this year around Bitcoin strategic reserve or something like that. There's a lot of things that can pump the market, a lot of narratives that can pump the market. Okay, and I don't think Donald Trump really wants to cause a mega super recession or a gargantuan bear market in stocks because that's actually counter to the things that they want to do. It's counterproductive. Bit of a scare, fine. Complete Armageddon, not good. Also a reminder, next time we see a big market run up coming, and there will be one, there's always one, guys. Take some damn money off the table so you're not so stressed out next time. This is not the time to be going super mega hardcore leverage this week either. There's a lot of volatility in both directions, but play it smart, okay? This is the time when the patient will be rewarded. So let me know down below, what's your prediction for the second quarter of this year? Is the buy in April and sell in June idea going to work out for us? Maybe. A lot of things are pushing us in that direction. Be curious to see if we get it playing out or not. Thanks for watching.